Good morning. Good morning. This is Valerie Leonard. I just want to say hello. I am the founder of nonprofit Utopia, and I want to say welcome back. It's been a while since I have been here with you live. We're going to talk about 10 common mistakes that nonprofit founders make. And hopefully, you'll learn a little bit about how you can avoid making these same mistakes yourself. All right, so if you can just bear with me one moment, I will get to the presentation itself. So we'll talk about the 10 common mistakes that nonprofit founders make and how to avoid them. And and these are mistakes that you will have from starting your organization as well as from managing. So we're going to start with the most common mistake that folks make, and that's with their articles of incorporation. If you're anything like I am, you tend to answer the question that is asked on the form using common sense, common language, and that is not what the state of Illinois is looking for, and it's certainly not what the IRS is looking for. They're not looking for commonsensical answers like, when you speak to the purpose of your organization, it's not enough for you to say your mission is XYZ. It's not enough for you to say that we came about in order to do ABC, right? You definitely, if you're in the state of Illinois, you're going to have to choose from one of 11 different purposes that are legally permissible. And just because those purposes are legally permissible in the state of Illinois does not mean that that is okay with the IRS. So you could conceivably be okay as far as the state of Illinois is concerned, but not have your article of incorporation approved by the IRS when it comes to seeking your tax exempt status. So if you're at a point where you are just starting your organization, literally just starting your organization, you're going to need to do the articles of incorporation, and you're going to be mindful specifically, or in addition to, I guess, more mindful for these two parts: Article 4, which is your purpose, and then Article 5, which would be additional provisions. And this is in the state of Illinois. Article 4, you would indicate your purpose. Your purpose would literally be copied from the IRS website. They have specific language that is lifted from the tax code of the United States. So you need to indicate that your purpose is um, exactly as they indicated. So it will be for educational and charitable purposes, blah, 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 but it has to be the exact wording that you would find from the IRS. If you're at a point where you want to be mindful of what the IRS has to say, right? You want to comply with what the IRS is asking, but at the same time, you want to make sure that when you start your organization that you're creating a culture that remembers why you got started in the first place. You will start off by indicating the IRS language, and then you'll have a clause that says something to the effect that specifically, and then you'll add your mission statement, and that satisfies the IRS need to know that you're organizing, pursuant to the tax code, but it also satisfies your organization's need to make sure that people always remember the why you're doing this work. All right. Now, when it comes to additional provisions, again, that's another area where you're literally going to plagiarize from the IRS website. You will be adding provisions as to what happens if you should dissolve the corporation, um, and that will be, you'll need to dissolve, and then you'll distribute the assets to another tax exempt organization. You, as the board, or you, as an employee, can't dissolve the organization and then take it upon yourselves to take the assets because you're the community, right? You have to distribute those assets to another organization. There is also another annulment clause that indicates that you can't exist for the private benefit of your key people, meaning board members and key officers who run the organization. A for profit company can distribute profits. Since you have no profits to distribute, any money that you have left over from the end of the year has to be plowed back into the organization. It cannot be distributed as a dividend to the people who are running the organization because it is a public trust, and it's really not owned by any one person, right? So be mindful of those particular provisions. And if you go to the IRS website, you will find a list of all of those provisions. And in fact, you'll find a sample organizing document. If you are a member of the Nonprofit Utopia community, you will see, a copy of those sample organizing documents. Or if you're a member of a class that I'm running on starting nonprofit organizations 90 days to a new nonprofit, then you'll also have the sample documents there. All right. So, a big problem with that, again, if you're not in compliance with IRS standards, again, you can conceivably be in compliance with your state's standards, but not with the IRS standards. If you find yourself in that situation, the IRS will return to you a copy of your articles of incorporation, and they will not grant you tax exempt status until you make the amendment that shows that you're organizing pursuant to the United States tax code. And that would mean you would have all of that mandatory language. And that might require, if the state of Illinois or whatever state you're from, if they have approved your articles of incorporation, it may require that you do an amendment. And then you'll have to submit the amended articles of incorporation to the IRS so that you can get your tax exempt status. All right, if there are any questions about that, please feel free to post. When I'm done, I will review all of the questions. Another reason why it's important for you to do your articles of incorporation such that they're in compliance with the IRS standard is organizations under $50,000 budget. They can go ahead and use the expedited form or the short form, not the expedited form, the short form, and there's very little documentation that's required. You're not going to have to submit a copy of your bylaws. You're not going to have to submit a copy of your articles of incorporation and other stuff that you would normally need to provide with the long form. What you would be doing is attesting to the fact that you have these articles of incorporation and they were drawn up pursuant to the tax code. But what they have found is that in many instances, when people do this short form, they're checking off the box saying they have this, that, and the other. But when they go ahead and review the articles of incorporation, they find out that those articles are not in compliance. So you definitely want to make sure that your articles of incorporation have the right language so that you're in compliance with the IRS. Another biggie I see is failure to register with the Attorney General's office. So, legally, before your organization can engage in fundraising, they need to be registered with the Attorney General's office, put them on notice that one, you are in existence, and if you are in existence, if you have any assets, if you have any income, here are the assets, here are the liabilities, here are the income or revenue, here are the expenses, and all of that good stuff. The Attorney General's office wants to know all of that stuff before you start fundraising. If you don't have that before you start fundraising, then you will need to pay a $150 late fee for one, the form that you use to register with the Attorney General's office. And that's here in the state of Illinois. Each state is different, but in the state of Illinois, if you engage in fundraising and they don't have this form on file, the CO1 form or the CO2 form and the AG 990, all of those forms together, one to that registers the organization, and two, it lets the Attorney General's office know about how much money you have in the bank, how much money you have had, I guess as a part of another organization or an as an unincorporated entity, but it just gives them a sense for, whatever your financial performance is currently and what they expect it to be in the future, although, it's just giving you a current picture. All right, so I have worked with organizations who have never filed these forms, even though they were in existence for several years. And you don't want to find yourself in that situation. If you find yourself in that situation, you're going to have to go back and file for every year you've been in existence or every year you did not file your AG 990. You're going to have to do the form CO1, CO2, and the AG 990 for every year. And then every year that you have been in existence, and you're going to have to pay $150 late fee for every year that you failed to comply. So, how do you avoid being in that situation? If you're going to start your new organization, you should go to the um, Attorney General's office. They have guidelines for all the documents that you need in order to not only start an organization, but to get your initial compliance together. The same is true for the Secretary of State and Nonprofit Utopia. We have a list that's even more comprehensive than the two put together, because we take an inventory of every state agency that's going to require some filing from you, right? So, again, the way you prevent this is make sure you understand before you even start your organization what's going to be required in terms of reporting. Another problem is unaddressed conflicts of interest. Now, it almost goes without saying, at some point or another, almost every organization is going to have apparent conflicts of interest, and you really don't want to have those situations, but in some cases, they can't be avoided. You need to have a conflict of interest policy, and you really can't get your 501c3 unless you have the conflict of interest policy. If you're doing an expedited form, you have to attest to the fact that you do have that on file. So you need a conflict of interest policy. You also need to demonstrate that you are following that policy, though. So that policy is going to define what a conflict of interest is, what happens in the event that there is a conflict of interest, and it should have some mechanism where you're disclosing every year whether or not you have a conflict of interest. In some instances, organizations, they may have those systems in place, but they still get to a point where they have conflicts of interest. There's a significant number of conflicts of interest amongst, say, family members or amongst business partners, even amongst board members. And if the IRS, just randomly, looks at your Form 990, which is your annual return, and they notice a significant number of conflicts of interest, that could leave you open for further investigation. And you could, and there have been some instances where people have lost their tax exempt status because of the conflicts of interest. There were so many conflicts of interest that it appeared that the people who were running the organization were not in the business of addressing a public good, or making sure that they were doing some really good educational or charitable work, but they were really creating these nonprofits to enrich themselves. So you don't want to find yourself in a situation where you have unaddressed conflicts of interest, or you have so many conflicts of interest that it raises a red flag and you will be subject to investigation and even subject to losing your tax exempt status. All right. Another common mistake is building boards around friends and family. So often when we start our organizations, we're so busy um, trying to get the thing off the ground that we don't necessarily want to wait and put all the systems in place where we're taking our time to build a board. A common practice is to get close friends and family on a document, and when I say on the document, I'm talking about on the articles of incorporation and other documentation, so that you can just push through this process, right? Because, it's a cumbersome process. It takes a long time, and, we tend to reach out to the people who are closest to us. That may work in the short run, but um, over the long term, it's not such a good practice. One, when you have lots of family members on your board, that could create a situation of conflict of interest, and if nothing else, tension around nepotism and other relationships as it relates to family. It could damage some of your family relationships because you never want to mix business and family, and it could also damage relationships amongst the other board members, other employees. And when you are filing for tax exempt status, you have to disclose whether or not there are any family relationships. You have to disclose any conflicts of interest, and usually your family relationships are conflicts of interest. The one exception that this would not raise a red flag is if you're starting a private foundation and it's a family foundation, but you really, really don't want to create a situation where the majority of your board members are friends and family. That's a recipe for disaster. One, because you create a situation where you can have what we call insular thinking. Everybody tends to think similarly, and it's important that you have the same values. But if everybody has basically the same level of knowledge, the same circle, it keeps your circle narrow, and it can really, really keep your organization from growing, right? Because nobody wants to step on their friends' toes. Nobody wants to step on the toes of family members. Everybody wants to keep the peace. But remember, when you are serving on a board, or if you're running an organization and you're building a board, the board has a fiduciary duty to have, a duty of care. They need to weigh each matter that comes before it in a very rational way. They're looking at the pros and the cons, and it's very hard to be objective if you got friends and family who might have some business that comes before the board, right? They also have a duty of loyalty, which means that their first uh, obligation is to the organization itself and not to friends and family. It's to the organization and not to to one another's friends and family. So it's best to keep friends and family off your board. It's best to get people that have similar core values as you. Obviously, good goals and objectives, sound judgment, and all of that good stuff. But you also want people who are willing to think independently and really put their own differences or their own opinions aside, for the good of the organization. Another problem is selecting board members who haven't bought into the mission, right? And I mean that in a literal sense as well as a figurative sense. So, in a literal sense, you have all seen board members that, they sign on because, they're trying to support a friend. They may not go to a board meeting, or they may not be enthusiastic about the mission, so they may not contribute financially, right? They will watch the founder work, or they will watch the executive director work but not give any money, or they will watch the executive director or the other board members work and not contribute to any of the labor. They may not share their networks or any of that stuff. And you get to the point where people who haven't really bought into the mission are a drag on the mission, a drag on the ability of the organization to move forward. The worst thing you can have on your board is a bunch of people who are supporting the founder or supporting a friend, but they're not enthusiastic about the little children or the dogs who have been rescued from the street and all that good stuff. So you need enthusiastic board members who are willing to share their networks, who are willing to share their money. All right. A big problem, I don't care whether or not you are just starting the organization or how long you've been in business, so to speak, as a nonprofit. A huge problem is not investing in capacity building and building strong organization systems. So that starts with strong board development. You need policies and procedures for your board. People need to understand their legal responsibilities, their financial responsibilities, as well as the work that's involved. And there needs to be systems to measure how well the board is contributing in terms of the workflows, in terms of the financial giving. So there needs to also be financial policies and procedures in place, human resource policies and procedures in place, and those need to be reviewed by an attorney. You also should have a strategic plan and a way to measure how you're meeting your goals and objectives. You need to have systems in place that show that your programs are effective, show how those programs are working, policies and procedures, and all of that unsexy stuff that nobody really wants to deal with. But if you don't have those systems in place, you're not going to be able to grow. Why? You will find yourself every time you're engaging in a new process or a same process, just reinventing the wheel. You could save yourself a lot of time by creating processes so that the people in your absence can do the work. Organizations that have strong systems in place, they grow much, much, much faster than organizations that are just doing things by rote memory. And also, you want to have systems in place so that, when you're absent, the work continues. When you leave or when other key people leave, the work doesn't stop. The organization doesn't go out of business because there's this one person who has all of the knowledge, right? Another problem is not being in compliance. So, not being in compliance with what you told your funders you would do. Your funders would want you to provide monthly reports, quarterly reports, reports at the end of the year, and sometimes they might give you other conditions. Same for the government regulators, government funders, as well as regulators like the IRS, the department, Illinois Department of Revenue. Other states have their own departments of revenue, making sure that you're paying payroll taxes. And, again, just making sure that you have all of your ducks in a row. You filed all of the paperwork. You've filed all the taxes and paid all of the taxes. So you can get in trouble for not filing as well as for not paying. And sometimes you can get in trouble for both. And the consequences for not being in compliance can vary, all the way from, just a slap on the wrist, paying a fine, to, being shut down altogether, right? So you really, really want to make sure that you're in compliance with your funders as well as government agencies. Another problem is not enforcing bylaws. Why do you go through through the process of developing bylaws if you're not going to follow them? And I know this sounds very, very basic, but many people go to board meetings and they don't bring their bylaws. It's important to have your bylaws in a binder at every meeting in the event that you're discussing something and you have a gray area, and you need to, be sure that you're operating within the laws of the organization, and those laws are really in compliance with your own state laws. So it's very, very important that you enforce the bylaws. Two of the areas that people, I find, or that organizations really don't enforce are things like the quorum and attendance, right? If you are not, if you don't have enough people in attendance for a quorum and an important vote comes to pass, you could really find yourself, in a lurch. There may be emergency situations that you can't address because you don't have enough of the people um, present to actually transact business that could make a difference financially, or whether or not, the organization gets a grant. In some cases, there may be some court cases that are involved, but it's really important to enforce bylaws, particularly around attendance. Right? We tend to underestimate that. If there are other provisions, in terms of meeting, in terms of staggered terms, and all of that stuff, and making sure that people perform certain duties, all of that impacts, your ability to grow, your ability to transact business. And if you let one person slide, then that creates a morale problem with everybody else. So you want to make sure that you enforce your bylaws and every other policy and procedure, enforce it, equally and fairly. Another problem is hiring the wrong professional. So what do I mean by that? Obviously, you want to hire people who are competent, right? So that could be employees, making sure that they have the requisite skill set. Sometimes you might want to take a chance, on hires who, have the potential, but they don't necessarily have the experience, or they may have a basic skill level and you want to take the time to develop them. But if you are hiring an employee who doesn't buy into the mission, doesn't seem to have the aptitude to get to the point where they could ever learn the job to a point where you need, the machine to continue to work, that can be a problem. Other cases would be hiring the wrong attorney. And when I say hire the wrong attorney, sometimes we think just because people are attorneys that they know nonprofit. Sometimes we think that because they are accountants that they know nonprofits, but that's not true. Attorneys are very much like doctors. Not every doctor is a brain surgeon. You're not going to go to a pediatrician to operate on your brain. So the same is true for your attorney, same for your accountant. You want to make sure that your attorney and your accountant are well versed in nonprofit, so they could prompt you, make sure that you're keeping up with your filings and that everything that you're doing is within compliance of the federal and state regulators as well as with your funders. I can remember a situation. I had a client, they started a nonprofit, and in their minds they're like, okay, we're a nonprofit, we don't need to pay taxes, right? So it never occurred to them to file 1990, right? And they had a bookkeeper, they had an attorney, but their bookkeeper and their attorney were not they were not nonprofit people. So the bookkeeper and the and the attorney never had an inkling that they were supposed to be filing their 990s, right? So they almost lost their tax exempt status because they were in operations for over 3 years without filing the 990s. And it didn't help that they moved around. They were in two or three different offices and they had changed um, the registered agent. So all of those things kept them from getting their legal notices. So they didn't know that they were supposed to file, right? And the IRS and the state didn't know that they moved because they didn't know that they were supposed to file a change of registered agent and all of that stuff. So you really, really, really want to make sure that you have an attorney who knows taxes and nonprofits. You want to make sure that you have a CPA or a bookkeeper that knows, nonprofits. All right. It could save you it could save you lots of money in the long run. Another problem is not keeping minutes. As you probably know, meeting minutes are legal documents and they could be, you know, required as evidence in legal proceedings. So you want to write your minutes as if they would appear in a court of law. You want to make sure that the minutes adequately record any major transaction and any major votes, any major decisions, right? Because you want to be able, and not just for legal purposes, right? But there may be people from the community, there may be funders who want to fund you. And by law, if people want to inspect your minutes, they can. Inspecting the minutes gives prospective board members, prospective donors, a glimpse as to how well the organization is running or not running. It also helps them make a decision whether or not they want to join. Right. The minutes can also help you, the board, to manage your board meeting, all the processes, right? Manage the organization, keep track, and not get stuck. So never, ever, ever underestimate the importance of keeping minutes. And your minutes are permanent documents, right? You don't throw those out. All right, so I have finished, my little presentation. If you have any questions, feel free to post. I will go into those questions shortly. Um, if you have any questions, if you're not a member of the Nonprofit Utopia community, feel free to email me at ValerieFleonard@nonprofitutopia.com. If you want to learn more about Nonprofit Utopia, you can go to our website at nonprofitutopia.com. If you want to join our community, you can go to nonprofitutopia.mn.co. Alrighty. Are there any questions? All right. So I don't see any comments. I want to say thank you so much to those of you who have joined us. Um, if you if you feel comfortable, before we leave, if you can just let us know your name and where you're from, so we can say hello to one another and acknowledge your presence. All right. So I'll wait a couple minutes because I know there's a slight delay. All righty. It doesn't look like there are any questions, doesn't look like there are any comments. I just want to say thank you again. The replay will be available on YouTube. If you're in the community, the replay. Hey, Audrey, how are you? All right. It's great to see you. Thank you so much for giving us a shout out. It doesn't look like anyone else is going to say hello, and I'm not going to just focus on a bunch of dead time. So, thank you again, and I hope to see you soon. Take care. Great. Thank you. Bye bye.